The Brussels Report Podcast.
Welcome at the new episode of the Brussels Report Podcast. My name is Peter Kleppe, and I'm delighted to have as my guest today Ronnie Stoeferle. Welcome.
Hi, Peter. Thanks for having me.
So, Ronnie, to introduce you, you're a managing partner and fund manager at Incrementum AG, which is based in Liechtenstein.
Yes.
Great country. You've worked in banking for a very long time. Before you were at Erste Group, where you were the author of the In Gold We Trust report. And you have already published 15 editions of that seminal report on gold, which has received a lot of attention in the most important financial media. Also, I want to mention that Ronnie manages a fund which invests on the basis of the principle of the Austrian School of Economics, which I think is a very sensible idea. So again, very, very welcome.
Thank you very much, Peter. Thanks.
So maybe let's start with the In Gold We Trust report. What's the most important element of the most recent edition?
Well, we published the last report on 24th of May, and the title was Stagflation 2.0. And you can download the report. It's almost 400 pages. You can download it for free on our webpage. And on the front page, on the cover, we do have a wolf. And a little bit in the background, we've got a bear. And why do we have those two animals on the cover? Well, first of all, we wrote a special report called The Boy Who Cried Wolf in fall 2020, when we said inflation will become a major topic. Now, obviously, that call was pretty accurate, and the bear that is coming in the background should basically show that a recession is coming up and a bear market in financial markets. And I think this call was also quite accurate because since we published the report in end of May, quite a lot of, let's say, interesting things have happened in financial markets. Now, the title of the report is Stagflation 2.0 because we compare the stagflationary environment to the 1970s to our current setup, and we say, well, there are many similarities. Actually, it was the highly inflationary 1960s that were the main reason for the inflation or the stagflation in the 1970s. Then, obviously, in the 1970s, we had major issues coming from the energy industry.
Yes.
But there are also quite a lot of differences, and this is primarily what we're explaining in this report. And then, obviously, we analyze what works in inflation, what works in stagflation. How do you have to adapt and modify your portfolio allocation? So those are basically the main topics of this year's In Gold We Trust report.
Okay, interesting. And to what extent can we blame inflation on central banks? And to what extent can we blame inflation? Of course, not understood in the Austrian way, but in the sense of CPI increases. To what extent can we blame it on the energy crisis, the fallout of COVID lockdowns, and of course the war?
Well, Jay Powell, he said recently, we now understand better how little we understand inflation, which is an utterly remarkable concession. I mean, the Federal Reserve has one job and basically 400 PhDs to help Jay Powell understand inflation, but he openly says, well, we don't really get it. So I think it would be naive to say, well, it's like Joe Biden did. It's the Putin price hike, and it's only the Russians that are being responsible for the inflation. So I think, I very much adhere to the Austrian School of Economics, and Mary Rothbard brilliantly wrote that there's three stages of inflation. First, there is monetary inflation, and we have seen that, obviously. I mean, since the year 2007, 2008, balance sheets of central banks, yeah, they're up a significant amount in absolute terms, but especially relative to GDP.
Mm-hmm.
Um, so definitely we had a huge amount of monetary inflation. The second stage is asset price inflation. And Peter, we lived through this everything bubble over the last couple of years.
Yes.
So it was not only equity markets doing very well, it was also bond markets, obviously. It was
Mm-hmm.
the art market, it was real estate all over the globe. It was commodity markets to some degree. It was the crypto market. It was, collectibles and stuff like that. So obviously there was much, quite a lot of liquidity flowing around, causing an asset price inflation. And now the third stage, according to Rothbard, is consumer price inflation. And now this is clearly playing out very well. Um, until recently, central bankers told us, well, inflation, it's only transitory. It will come back. But now they realize that actually it's much more sticky than anticipated. And I think what happened since the spring, when I think expectations for interest rates in the US were roughly at 1.5%, and then the markets realized, well, um, now they are getting really nervous, and they start becoming more hawkish, and now expectations for interest rates by the end of the year are at 4%. So that's really a big move. And the consequence was that this everything bubble has completely exploded, or let's say imploded. So just to give you two numbers, until the end of August this year alone, so year to date, equities have wiped out 21 trillion of global market cap, and global bonds in aggregate
Mm.
have erased 16 trillion. And then add on top, the suffering in the crypto markets, in real estate, in private equity, and so on. So this is actually a massive deflationary move that we're seeing in asset prices.
Yes.
So for me, as an analyst or a fund manager, I think understanding this interplay between consumer price inflation and asset price deflation is now really the most important thing to analyze, to think about, and to act according to my assumptions.
And I mean, I have the impression that there's different views on the following. Is the Fed for real? Are they going to actually, continue with their plan to hike rates? And secondly, is the ECB for real? Because of course, for the ECB, I would say it's even harder. The eurozone may collapse if they properly increase interest rates, as they should. But
Yeah.
obviously, the collapse of the eurozone would be a traumatic event. I'm not a fan of the eurozone, but I think it's very hard to see how you can unwind it in an orderly manner. So that's why I'm personally leaning to. I think Peter Schiff also agrees with that. The fact that at some point the Fed will pivot and the
Mhm.
politicians will force Powell, whatever he thinks, to do what they want him to do. And most certainly, I think, I'm afraid, I don't support it. This is also what's going to happen here in the eurozone. So, what's your view on this?
Well, let's start with the Federal Reserve, and actually, I'm not the biggest fan of the Federal Reserve, but we have to say on a relative basis they did a much better job, and I think they played it more pragmatically,
Mm.
and just smarter than our friends at the European Central Bank. Now I think the Federal Reserve will have to pivot at some point, and I don't agree to the point that many people nowadays make that actually the Federal Reserve is very hawkish. Well, I mean, let's face it, we've got the most negative real rates
Mm.
in the last 50 years. So actually, if they were really hawkish, we would have to see interest rates significantly higher. So,
Mm.
so I think the Federal Reserve knows quite well that actually we are already in a recession. They know quite well that this reverse wealth effect that they're adhering to, and that this seems to be the game plan. That this is causing serious trouble when it comes to consumers, when it comes to economic confidence. So from my point of view, the turn, this Fed pivot is near. It's not very close yet, but it's coming closer definitely. And I think, we've got midterm elections coming up in the United States. So I think over the next couple of weeks they will kind of pivot, but of course it's all about trust. It's all about confidence in the Federal Reserve and the system. So they cannot say, well, okay, that's it for now, and we will make the U-turn, stop quantitative tightening, and go back to quantitative easing.
Mm.
Um, it will be a process, and I think at the moment markets are already they're starting to discount this process of a Fed pivot, but
Okay.
it's not there yet. So I think we might see one or two legs lower in US financial markets going forward. Now,
Well, and yeah, sure. Please continue.
I think what's really important to say, Peter, is that it's not only interest rate policy that is becoming more restrictive. It is also quantitative tightening that
Mm.
is now really getting going in the United States. So they're raising it now up to 95 billion per month. And I think that's actually the most important price to follow at the moment. Um, the strength in the US dollar, it acts like a big wrecking ball for financial markets.
Mm.
So this is really, from my point of view, one thing that people should follow very closely at the moment. And the US dollar at the moment, and this leads us to the eurozone.
Mm-hmm.
I think the strength in the US dollar might really cause, first of all, a sovereign debt crisis, especially in emerging markets, but also coming to the Eurozone.
Mm-hmm.
And then, on the other hand, it acts like an additional big tightening for financial markets. So I think when it comes to the eurozone, I don't have any polite words to say, to be honest, and I don't want to start swearing right in the morning. Um, but I think it's embarrassing what's actually going on, and just have a look at the price of the euro, not only versus the US dollar, but
Mm.
also versus the Swiss franc, for example, but
Yes.
also
Yes.
some emerging market countries. So my roads roadmap for the next couple of months is, um, actually, I think that inflation will be much more sticky in the eurozone than in the US, because
Mm-hmm.
due to the weak euro, we are importing more inflation, so we have to pay more for importing goods, obviously. then I think what we will see is more pressure coming from Putin. So he will strong arm Europe by completely shutting off energy pipelines, causing a further spike in prices. I think what we're seeing now already is, obviously that electricity and gas bills are exploding, and that governments are stepping in, and they are deploying price caps
Mm.
on energy for consumers, and probably also for companies and industries. But then I think, as markets will realize, well, this is going to cost lots of money, and this is
Oh
going to
yes.
be probably not billions but trillions of euros. I think that bond markets will increasingly become nervous. So the next step would be that this anti-fragmentation tool that Lagarde kind of announced over summer. So basically, a spread management. Um, so this will be one solution for the problems. But I think that going forward, they will have to introduce some sort of yield curve control. So um, it would be naive to think that the ECB will basically come up with a more Austrian approach and say laissez-faire. Let's let the markets decide. I think they will start printing big time, and they will start
Mm.
intervening big time. And and this is obviously gonna
Make
make
inflation worse, right?
make inflation worse, and actually cause the US dollar, so the Dixie, which is 58% of the Dixie index, is the euro. This will
Mm.
probably cause the Dixie to rise significantly further. So, and then we'll see what they will do if they introduce like big swap lines between the ECB, the Federal Reserve, and the Bank of Japan. They
Mm.
already started something similarly in July 2021. So that would be a solution. But I think, it's gonna be a very, very, let's say, interesting fall and winter over here. And I think, as I've said, on a relative basis, the United States is in a much, much better position than we are.
And sort of, if you're an ordinary saver, I mean, if you would have to say, like, name three things that ordinary savers can do to defend themselves against all of this, I mean, also based, of course, on the In Gold We Trust report, what would those three things be?
Well, yeah, well, actually, I think that gold should should protect your purchasing power quite well. Now everybody is just staring at the dollar price of gold, and is kind of
Mm.
yeah, frustrated with the performance. But we have to say that the strength in the US dollar obviously is the main reason for that. If we
Mm.
have a look at the price of gold in euro terms, it is up 8% year to date.
It's at an
Uh,
all-time. It's near an all-time
it's
high.
yeah,
Yeah.
exactly. In the British pound terms, it's up 10%.
Mm.
In the Japanese yen, and they're probably even a couple of steps further in their monetary madness. I think they
Yes.
already had 13 or 14 rounds of quantitative easing
Mm.
already, and now they are employing a very, very aggressive yield curve control. If we would compare that to the United States, their yield curve control would be the equivalent of 300 billion per month. So, so the Japanese they are really even closer to the end game. So
Mm.
gold is up 14 or 15% in Japanese yen terms. And I think for euro-based investors, as I've said, gold did a good job actually in
Yes. Yes.
protecting your purchasing power, in being a reliable um, um, a safe haven in your portfolio.
Mm.
Um, Peter, I'm from Austria, so Austria is like one of the biggest skiing nations, and I always say, well, if the weather is fine and if you've got good snow conditions, then everybody is a good skier. But if it's icy, if it's foggy, then you can really differentiate
Yes.
if one is a good skier or not. And I think it's the same with asset management. I think you have to be really, really um, active. You have to probably switch your positions more often. I think it's not the time to be stubbornly long only and to only invest in passively in ETFs, and this was obviously, besides ESG, that was the big trend over the last couple of years. So
Yes.
I think it's really now the time for active asset management.
Okay.
um, and therefore, we hope, of course, and we think that we're good skiers and that we will be able to manage our clients' portfolios and our funds well in this crazy environment. Because I mean, let's face it, there's major threats, but there's also lots of opportunities in these kind of markets. And
Yes.
I think that um, you know. Counterparty risks will become more important. I think it's much more about the balance sheet quality. It's really more a trend regarding real assets. So obviously commodities, but also high quality stocks, value stocks. I think that sound money currencies
Mm.
should do really well. But it's I think for most, let's say, traditional balanced portfolios, this is going to be a pretty tough environment because, as I've said at the beginning, it's not only equities that are suffering, but also bonds. And then if you add 10% inflation on top of that, that's
Yeah.
a pretty nasty wealth destruction that we've already seen over the last
Absolutely.
couple of months.
And maybe before you go, what about silver? If I'm not mistaken, the gold silver ratio is at a very low level, or at least silver is a comparatively low level as compared to gold. Isn't it the time to go hard on in silver now? Or I heard somebody making the point. Well, no, because to mine silver you need lots of energy, and energy prices are so high. So this affects silver prices.
Well, I think many let's say my wife, she hates that analogy, but silver is a little bit like um the ex-girlfriend that you're still kind of interested in, and that you should rather avoid seeing. So I think with silver, it's like it's tough trading silver. It's just highly volatile, and I think that um, if we should see this Fed pivot, and it will happen at some point, because if you understand monetary history, then it's crystal clear that when, sorry, the shit hits the fan, they will start printing again. No fiat money system ever collapsed due to deflation. It has always been inflation.
Okay.
So I think at some point they will have to reverse big time. And we also know this declining marginal utility. So actually the next rounds of QE will be bigger. The next rounds of fiscal stimulus will be bigger, obviously, to have an impact. And then I think when gold starts picking up momentum, silver should also pick up momentum. But now, for the time being, I could expect some more, downside risk. Silver has this kind of attitude that it really spikes down big time. And then this might be a great buying opportunity, but it is really, really a volatile beast, and therefore clearly, you really have to follow it much more closely than with gold, which is definitely more conservative and less volatile.
All right, and then maybe to conclude, most people don't have physical gold or physical silver. They don't have crypto. They don't even have stocks. Most people, if they invest, they have real estate.
Yeah.
So I mean, and I think you can understand them. Look, you have to live somewhere. So it sort of totally makes sense then to put a sizable part of your wealth into your house to avoid rent. So, I mean, how are, especially in Europe, people that are deep in real estate going to fare in the next 10, 15 years?
Well, I think it's I cannot make like a general forecast for real estate because it's just a very complex asset class. But what I can say is over here in the German-speaking world, it's also called concrete gold, because actually since the end of World War II, basically nobody really lost any money investing in real estate. At least on a nominal basis. On a real basis, that's a different story. While in the United States, people are just much more accustomed to volatile housing prices. I think over here, if what's gonna play out, stuff that I'm kind of expecting, then I would say that that actually governments at some point will say, well, perhaps let's do a special tax on real estate, and obviously this is only going to be for the millionaires. But nowadays, if you own a flat, if you own a flat and it's like in a somewhat decent neighborhood, due to the weak euro, you can have an apartment or a small house that is worth more than $1 million quite quickly. So I would expect higher taxes and windfall profit taxes or whatever. So that might be an issue. And of course, with real estate, it's just, if you own a house, it's just you're not that flexible anymore if you perhaps want to leave the country for whatever reasons. So those are issues that I kind of have with real estate. But as I've said, I think making like a broad general forecast for real estate in Europe is probably shouldn't be done. That's not something that I would do with a good feeling.
All right. Well, that was very very interesting, and I'm sure also very informative, instructive for our listeners. So Ronnie, thank you very much. We will definitely continue to follow your work. I will put a link to the In Gold We Trust report, and yes, let's stay in touch.
Thank you very much, Peter. Thanks for having me. I hope you and especially your listeners enjoyed it. Thank you very much, and yeah, all the best. Take care, my friend.
Thank you. Thank you.
The Brussels Report podcast.